Welcome to vTalkInsight, Market Drivers Daily for April 7th, 2026. Oil has doubled since January. A harder-on deadline looms for tonight, and yet equity and volatility markets still look oddly relaxed. Today we unpack what that tension means for energy, credit, and the AI trade. Geopolitics around the Strait of Hormuz remain the single biggest macro swing factor, with the U.S. Iran confrontation now embedded in both oil prices and growth expectations. Oil has surged to levels not seen since 2022, with Brent holding above $100 and refined products like jet fuel and diesel rising even faster, shifting the debate from a short price spike toward a broader and more persistent energy shock. On the ground, tanker traffic through Hormuz is still far from normal, with only a handful of vessels, mainly from India and Iraq, reportedly making the transit while many ships turn off tracking systems, underscoring how fragile supply remains. That reality is showing up in pricing. Physical barrels trade at notable premiums to futures. The oil curve is deeply backwardated, and 6-month Brent is roughly 35% below spot, all of which signal heavy near-term scarcity, even as markets still assume a relatively quick normalization. The policy implications are highly path-dependent because the same shock can be inflationary or demand-destroying depending on duration and severity. Scenario work suggests that if oil averages around $110 this year, global growth could slip from roughly 3% to about 2%, while headline inflation might approach 5% by April as gasoline, diesel, and airfares feed through into consumer prices. Cross-asset signals are conflicted. Bond markets have started to reprice inflation risk, with the U.S. 10-year yield moving toward 4.3% and European yield reversing part of last week's Haven rally as higher oil bleeds into inflation worries. At the same time, equity volatility remains relatively contained. S&P futures are only modestly lower after several up days, and options markets 6 months out show limited fear, even as oil volatility spikes and history suggests past 100% oil rises often preceded equity drawdowns of 20% or more. Regionally, the U.S. still looks comparatively insulated as a net energy exporter with AI and fiscal tailwinds, while Europe and parts of Asia face more acute recession risk from fuel shortages and higher import bills. Yet even in the U.S., sustained high energy costs threaten consumer spending, which makes up most of GDP and could intersect uncomfortably with already elevated inflation and a Federal Reserve leaning toward a higher-for-longer stance rather than imminent cuts. Key watch points now are tonight's Iran deadline, actual shipping volumes through Hormuz, refined product availability into the summer travel season, and whether central banks signal a willingness to look through the shock or to lean against it. Those policy and growth outcomes will be crucial for our next topic: how credit, especially private credit, absorbs this new macro stress. Private credit is facing its most meaningful test since the global financial crisis, not because of a systemic meltdown, but because liquidity and underwriting standards are finally colliding with a tougher macro environment. The asset class has grown rapidly to around $1.8 trillion and now accounts for roughly 9% of corporate borrowing, yet has never been through a full credit cycle, leaving investors unsure how structures and covenants will behave under genuine stress. Stress today is concentrated in semi-liquid and retail-oriented vehicles. Some managers, such as Blue Owl, have capped withdrawals after redemption requests reportedly reached more than 40% in certain funds, while listed business development companies trade at steep discounts to book value. By contrast, institutional heavy funds like Goldman Sachs' $15.7 billion vehicle report sub-5% redemptions and far more stability, highlighting a growing divide between channels that promise frequent liquidity and those designed for longer lockups. Under the surface, credit quality is deteriorating unevenly. CCC-rated bank loan spreads near 2,000 basis points flag deep stress at the riskiest end, even as BB high-yield spreads remain relatively tight around 200 basis points, suggesting investors are still differentiating aggressively. Direct lending to highly leveraged software companies looks particularly vulnerable, with expected default rates in the mid-teens annually for several years and potential recoveries as low as 10 to 20 cents on the dollar, which could be painful for managers with concentrated exposure. Despite these pockets of strain, the overall message from banks and policymakers is that private credit, on its own, does not yet resemble a systemic threat. It remains a minority slice of corporate funding. Capital markets for investment-grade borrowers are still open, and broad default rates have not meaningfully spiked. At the same time, major institutions such as Blackstone, Goldman Sachs, and Morgan Stanley are raising sizable new funds and launching interval products, positioning themselves to deploy into dislocation as retail money exits and lending terms move back in favor of providers. Looking ahead, much hinges on whether the macro backdrop stays in soft landing territory or tips into a harder downturn as energy shocks build. If growth merely slows, private credit pain may remain a story of idiosyncratic losses in older vintages, particularly in software, offset by more attractive spreads and stronger documentation on new deals. If instead oil-driven weakness pushes economies toward recession, today's liquidity crunch could broaden, with redemption pressure spilling into listed credit, private equity, and other alternatives as investors search for cash. That cyclical fork is also shaping the outlook for one of the key growth engines cushioning the shock so far, the AI investment wave. Amid geopolitical turmoil and credit jitters, the AI cycle continues to look like a genuine multi-year capital expenditure boom that is proving surprisingly resilient to near-term macro noise. Corporate leaders are shifting from delaying projects to actively investing in AI capabilities, hiring for related skills, and embedding automation in back-office and industrial workflows, which helps explain why U.S. productivity growth has run above trend for several years despite higher rates and uncertainty. The earnings tape underscores that momentum. Samsung just reported an 8-fold jump in quarterly profit, with around 90% of operating income linked to surging demand for AI-driven memory chips, even though its share price reaction was muted as investors debate how long these margins can last. At the same time, Broadcom has secured a 5-year agreement to supply custom AI chips to Google and is partnering with Anthropic, reinforcing its position in the accelerator stack as the SOX Semiconductor Index gains double digits year-to-date. On the software and model side, the demand signals are just as strong. Anthropic's annualized revenue run rate has jumped from roughly $9 billion late last year to more than $30 billion, while the number of companies spending at least $1 million per year on its services has doubled in roughly 6 weeks. ARM, meanwhile, is pivoting hard toward data centers and generative AI, with its new AGI CPU already booked by major clients and management sizing its AI and cloud addressable market at over $100 billion within 5 years. Importantly, this AI spending is seen as relatively non-discretionary, especially in the U.S., where abundant domestic energy and inventories provide a buffer against the current oil shock, helping to sustain capex plans even as other sectors worry about margins. Yet the trade is far from risk-free. Tech sector performance has become more volatile, with names like ASML under pressure from tightening export controls to China, while governance disputes, regulatory scrutiny, and intense competition among model providers introduce both headline risk and potential earnings dispersion. For multi-asset portfolios, AI therefore plays a dual role. It is a potential cushion for growth and earnings in an otherwise stagflationary backdrop, via productivity and high margin revenues in chips, cloud, and software. But it is also a new source of volatility and geopolitical linkage, given export controls, supply chain bottlenecks, and national security concerns ranging from semiconductor leadership to biosecurity. The key questions from here are how fast AI-related revenues scale relative to lofty expectations, and whether hardware and energy bottlenecks stay manageable as the next wave of demand for compute arrives. To wrap up, the Gulf energy shock and U.S. Iran tensions are now central to the macro story. pushing oil and refined products higher, nudging bond yields up, and creating a disconnect between elevated commodity volatility and still contained equity and FX pricing. Private credit is going through a genuine shakeout, with liquidity and sector concentration under pressure in some vehicles. Even as well-capitalized institutional players move into the gaps, and systemic risks remain limited for now. And the AI capex cycle continues to power ahead, supporting productivity and semiconductor earnings, but also concentrating leadership and adding its own layer of regulatory and geopolitical uncertainty. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.